You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth.
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. Got another local special podcast for you today, zeroing in on one of the biggest markets in the country, Los Angeles. I lived in LA for a couple of decades, and I've certainly got some opinions on the area, but today my guest is Larry Taylor of Christina Real Estate. He's the founder and chief executive officer of Christina. He's also a seasoned investor with over 40 years of real estate experience in the westside region of Los Angeles. He's worked on a lot of really big projects, including the development of the Montana Avenue Shopping District in Santa Monica, the revitalization of the South Beverly Hills Retail Shopping District, and the redevelopment of Westwood Village. So welcome.
Thank you, and good afternoon.
So I'm hearing all these stories in the news about people leaving California in droves, but I have a lot of friends who are real estate agents, and they're selling houses like like hotcakes. What are you seeing? That was a good one. What are you seeing in the multifamily market right now on the west side?
Well, the demand for the west side of Los Angeles, which is the only area that we have ever invested in or specialize in, has never been less than intense because the high quality of properties that are available, the location, proximity to the beach, it's just overall the most desirable part of Southern California. And so demand always exceeds supply. But what we do have is we have a very tired supply of multifamily housing. So we expect that we'll start to see a new wave of a second wave of redeveloping properties that were built in the 50s and 60s before we had upgraded seismic standards. So we see a lot of redevelopment happening, and because LA generally is a very new city, the west side is one of the newest parts of the city of LA, or the west side region of LA. So, but as far as the market, it's never not been hot, and that's 47 years of experience.
So in terms of redeveloping some of those places, are you able to add units? Can you go up, or what's the zoning like?
Again, the west side region of Los Angeles consists of multiple cities. And for people who aren't familiar with Los Angeles, as familiar as you and I are since you spent a number of decades here, is that the west side consists of the city of Santa Monica, which is a separate city, Marina del Rey, which is unincorporated LA County, the city of Los Angeles itself, the city of Beverly Hills, the city of West Hollywood, and the city of Malibu. All of that is considered the west side region of Los Angeles. And every single one of those municipalities has its own general plan, has its own zoning and regulations, and all of those cities have more demand than supply, and the ability to develop anything or redevelop anything takes a tremendous amount of time and effort, which is what continually and constantly drives values up. There are a number of new regulations passed by the state to encourage and expedite development of more housing. And the city of Los Angeles itself has new zoning and planning things that are meant to increase density. That really works in a lot of areas of the city of Los Angeles, but the west side is the west side. It's a NIMBY sort of thing, not in my backyard, and it's still very challenging. But that's what keeps values high. It's the near impossibility of developing or redeveloping anything. And there is no vacant land in the west side of region of Los Angeles, so it's pretty cool.
Yeah, the no vacant land issue is definitely a problem. I can't imagine that there's hardly any vacant land in Santa Monica.
No, there isn't. The last significant vacant parcel of land is now fully developed. That was Playa Vista, which is the old Howard Hughes property, which took about 50 years to redevelop. So there really isn't anything to speak of, but the west side is still the most desirable location, and we now have the SoFi Stadium in Inglewood, and that's where 2 National Football League teams will play, and it just goes on and on. The Olympics will be held there. Everything happens on the west side, and in my view, nothing else happens. So
So I'm assuming you've lived in the West Side all your life then?
I've lived on the beach in Malibu for 45 years.
Nice. Very nice. I think that's just about everybody's dream.
It was mine when I was 21, and that's where I've been since.
Awesome. So what do you think about California slowly reopening? You know, obviously we're starting to get vaccinated. Disneyland is opening back up. That's not on the West Side, obviously, but people want to go to Malibu. I think that, that Malibu always gets crowded. What are you seeing in terms of things opening up?
Well, it's spotty in terms of businesses gaining an understanding of what the regulations are. So for office buildings that have been closed for more than a year, they're just trying to get, our tenants are just trying to get clarification on federal, state, and local regulations as to how to treat their employees. So the people coming back to work is still a legal issue which is unresolved. And so there's a slow but steady pace of people returning to offices. And without people being able to return to offices, everything around it has to suffer, the retail, the restaurants, and so on and so forth. But what we're seeing on the West Side is intense business and foot traffic in restaurants and retail locations. But without the return of employees to high-rise office parks, a lot of technology companies, and so on and so forth, we won't have that demand really, what I would say, close to what it was until perhaps winter this year.
Interesting. What about the Silicon Beach area, Santa Monica, Venice? Are those companies that are more tech focused, are they planning to go back to the office, or have you seen more of that remote work plan kick in?
Well, again, there was a period of time not that long ago where almost everything was remote. And in the technology has always been able to operate anywhere in the world where they could get onto a computer system. But the co-working concept, bullpen theory, people crowded in rooms to brainstorm, that has changed. And although within the technology sector, there's probably 1,000 companies that have been formed in the last 5 years alone here in the Southern California, or more. And some of those companies might have only 2 to 10 employees, and some of them might have 200. But Google is just putting the finishing touches on their 557,000 square foot campus in the West Side region on Pico and Overland, which used to be the West Side Pavilion Shopping Center, and they fully intend to fill their campus. And 550,000 square feet is a lot. So I think, with vaccinations and the public feeling confident and a consistency in government regulations between state, federal, and local, barring any resurgence or reappearance of the virus, I think be stronger than ever, because a lot of people discovered the West Side during the pandemic and never really experienced it before, and they'll never leave.
Interesting. Who do you think discovered it in terms of during the pandemic?
Anybody that didn't live on the West Side.
So is that people moving from downtown or from other places?
Koreatown, downtown, the San Fernando Valley, the East Valley, the Inland Empire. I mean, the demand here on the West Side is so outrageous. I have never seen anything like it personally. And this is my 47th year. So, the West Side is booming. It's and when we talk about the West Side region of Los Angeles, on a size, it's larger than the island of Manhattan. So we're not talking about a small area. When I talk about, I forgot to mention Culver City as another city, which is conceptually, in the West Side region of Los Angeles, which is also booming. And we've got SpaceX. SpaceX is headquartered down in El Segundo, and all these companies that feed off of space technology. It's just incredible.
Yeah, El Segundo is an area that before was sort of mostly industrial, and then kind of, in the last decade or two has really gotten, gotten to be really beautiful. Lots of beautiful properties there.
Yeah, and we've got a refinery there that's been there for a long time, and a waste treatment facility that was put there a long time ago, which were kind of negatives for residential. And slowly but surely, those things are starting to become environmentally more sensitive, putting off less odors. They're being, more camouflaged. Even Playa del Rey, where we recently acquired a fantastic property on the beach, on the sand, is becoming much more desirable now because jets are quieter. There's less airplane noise. The routes have changed, and it's the only beach that's within 10 minutes of Playa Vista. So all of that is in that El Segundo, Silicon Beach area, which has always been attractive, but really has gained tremendous intense, what I call occupancy development and stuff like that.
Let's talk a little bit about the history of the West Side. You've spent your career there. There have been a lot of neighborhood changes. You mentioned Playa Vista. I mean, that land, as far as I know, was mostly not used for a long time. And then, then we've seen massive development there and a lot of tech campuses. What kind of sticks out to you as a really dramatic way that the West Side has changed?
I would not call it dramatic because it's always been popular, but I think with respect to Playa Vista, I had mentioned earlier that was 50 years in the making because it was considered an environmentally sensitive habitat, and there was a tremendous Sierra Club opposition to it, and former Councilwoman Ruth Galanter led the charge, which really defeated almost every effort to develop it. But ultimately, a deal was made to dedicate all the land west of Lincoln to the ocean, to the Bologna wetlands, which will always remain undeveloped, and then everything east of Lincoln Boulevard could be developed, and so an entire community grew up there. So you can, in other words, we see the emergence now of these independent live, work, play areas, which is different than what it was, 10, 20, 30 years ago. So I think what's emerged is the reality that you can live in Playa Vista for your entire life and never have to go anywhere else. Or you could live in Santa Monica and never have to leave because you could live there, work there, entertain, so on and so forth, and never really, unlike other major urban cities that rely on the central urban core, like San Francisco or New York or Chicago, where you have to go to the core and then everything feeds off of it. Los Angeles exists, the downtown can exist without anybody ever on the west side having to go to downtown, because the west side has all of those separate facilities, so you can live, work, play, eat, entertain, whatever, and never leave the west side. And that's a beautiful thing because LA's never had any mass transportation, although they're building a metro link system for the last 30 years, which will be able to bring people from these disparate parts of the whole Southern California region together, but it'll never be an interconnected subway type system that will allow people to get to exactly where they want to go. So if you might catch a train from downtown Los Angeles ultimately till Santa Monica, but when you get off the train, you're still going to need to go 5 to 6 miles to get to your next location. So you'll need a car or a bike or an Uber or something. But generally, because of the way that things have fully developed now, it's like I live in Malibu, our firm is based in Malibu. We never really have to leave here for anything. We have a university here, we have a library here, we have a courthouse here, we have our own police and fire here. We have our own restaurants and entertainment. We're across the street here from one of the highest grossing restaurants in the United States, Nobu on the beach. So, we don't have to go anywhere, and that's what's changed. So previously, when there was more reliance on having to go into town or go to Midtown, and all of the traffic issues that built up over time because we didn't have mass transportation, we don't need mass transportation because you're not leaving 6 square miles.
Interesting. Yeah, I feel like having lived in Los Angeles, people tend to be either East Siders or West Siders and not necessarily go to one side or the other just because it takes so long.
Yeah, but there was a need at one time. And there isn't a need for that anymore. Everything has changed. So you have these, like I said, you have these 6 or 7 separate cities that constitute the West Side. You don't have to go into a central city core. That's not how LA developed. And these communities have now become fully self-sustained. And so they all comprise the West Side. But from an investment perspective, what makes it more attractive than any other investment opportunity I've ever seen in the United States is that never-ending demand, never increasing supply. That's the only way you can make money in real estate.
That is a pretty good formula. You know, everyone is so familiar with the West Side and seeing it on television and reality TV shows and all of that. Is there any secret neighborhood that maybe people don't know about? I mean, I feel like Westchester was that for a little while, and then that blew up and everyone knew about it. Is there anywhere that you think that maybe hasn't been discovered, or is it just everyone knows everywhere?
Well, as I said earlier, it's a very, very large geographical area. And so there's pockets all the time that people are completely unaware of that, they just exist. Like if I mentioned Rustic Canyon, would you know where that is? Mm-hmm. Okay, well, a lot of people don't know about Rustic Canyon, Temescal Canyon, Kenter Canyon. There's whole areas of Lower Bel Air that are beautiful that people have never even examined. There's just a tremendous opportunity also because when these areas were developed, many, many decades ago, there was never a great impetus to overdevelop. So basically, the entire West Side is low rise. And so, it's just good neighborhoods get better and bad ones don't, in my view. And the West Side just continues to get better. But as far as undiscovered, Ocean Park, which was usually unattractive area of Santa Monica, really has, become much more popular in recent years. You hear a lot about Venice, but Venice has always been kind of a quirky little conclave of artisans and clowns. And at one time it was a separate city before it was annexed by Los Angeles in the early 1900s. It's a chaotic, interesting community that we don't really materially invest in. And Venice is being rediscovered. The Oakwood area of Venice, which was more of a low-income area, has now become more intensely developed and more affluent. So it's always ever-changing, but there's plenty of room for redevelopment of certain areas. The entire West LA area, which is not quite Westwood and not quite Brentwood and not quite Santa Monica, but it's this huge swath of land which has some industrial in it that's been added on one side or the other of the freeway that's starting to get some attention. So there's more to go, particularly around where the new Google campus is, which is the old Mar Vista Rancho Park area, which now will have I don't know how many hundreds of new employees that will start to populate the area and buy some of those old single-family Spanish-style houses, and you're seeing a lot of that. They're buying them for $2 million and tearing them down and building $5 million houses. And it's kind of fun.
Spec development is a whole other thing in Los Angeles. One thing I think that's really interesting is during the pandemic, just how much luxury real estate got snapped up, especially on the West Side. There was a little bit of an inventory problem of there being too much luxury real estate, I think, on the West Side, and that is not a problem anymore from what I hear.
Yes. Again, there's no land, so, you have, probably hundreds of small to medium-sized, developers who are buying houses and tearing them down and building them and selling them. But, we're going through a period of time where the government has printed about $9 trillion worth of money and injected it into the system and then lowered the cost of money to nearly zero and making it available to everybody. So, that's going to change because it always does. Money will tighten, it'll become less available, and, that's what we're hoping for so that we can buy more real estate.
Absolutely. How worried are you about fires? Wildfire season seems to happen earlier every year in Southern California. You're in Malibu. Malibu certainly had some major fires in the last couple of years. How concerned are you, and what do you think is happening in terms of fire prevention and fire safety?
Well, it certainly is a problem. After all, civilization is encroaching on the natural resources, and we back up to the Santa Monica Mountains, which are beautiful, but Southern California is also a desert that only came alive by the redirection of water from the Sacramento River. So it's very dry, and housing has been built in these hillside areas and alongside natural terrain, which it's a natural process for these areas to burn from time to time because that's just nature. What's happened lately is that we've gotten better fire equipment. We have helicopters that will fly out over the ocean and pick up water and douse them. We have a much better fire response team now. We have new codes and compliance requirements to clear brush within 500 yards of any structure. In severe hazard districts, you're not allowed to build anymore. The quality of the construction now is much more fire resistant. Cement tile roofs, no eaves or overhangs. So we're building better. We have a better response, which will hopefully reduce insurance premiums, which are very high in some of these areas where the best areas are the ones that are hillside or near natural terrain. It's where everybody wants to live because it's beautiful, and it's also as risky as you can imagine being next to wildlife and natural forestry. But we're better at it. We've just had a couple of brush fires recently in the Pacific Palisades area, and they were controlled rather handily and quickly with a higher level of fire response that we have. So it's getting better.
That's good to hear. You mentioned earlier money being cheap right now. One of the things that seemed like the story of the year last year was all of this capital on the sidelines getting ready for distressed assets. Kind of seems like those distressed assets never arrived. Are you seeing capital looking for opportunities in your area, and are they finding anything, or is it really still just as hard to buy as ever?
Well, again, with the unprecedented once-in-a-100-year pandemic and government ordering the shutdown of all of the economy, there's this great expectation amongst opportunistic investors that, wow, all these things are going to go broke, and landlords are not going to be able to pay their mortgages, banks are going to foreclose on them, we're going to buy things for 30 cents on the dollar. Well, the government was certain to not let that happen, starting with the first $2.3 trillion that was injected, was it that CARES Act that was the first injection, but all of these federal, state, and local regulations that were passed, and all the money that the government made certain that exact thing would not happen, and they just printed the money, they distributed the money through PPP, through excess unemployment, and in many ways that the public is not aware of that the government has done in terms of leaning on banks to say, don't foreclose, give forbearance, don't take properties back. So none of that distressed opportunity appeared, but so many trillions of dollars were created and so much cash fell into the coffers of people that there's even more money looking for opportunities at a time where there's less opportunities because distress didn't present itself when investors had that expectation, which is, of course, that's exactly right. If everybody thinks it's going to go a certain way, it definitely will go the other way. So, and so right now, there's a tremendous amount of capital. We've sold 2 properties in the last 5 months at prices that were higher than any prices we had ever imagined that we would sell them for, because there's just so much capital, so we sold. But next year at this time, it could be the exact opposite. And the exact opposite might happen when government starts telling banks it's okay to foreclose now, and these office buildings don't fill back up because people don't come back to work because they're either working remotely or they don't want to come back. And so we could see distress when no one's expecting it, which is usually how it works. So, there's a contrarian aspect to investing. There's almost never a bad time to buy good real estate. Certainly never a bad time to buy real estate on the west side, even if you buy it at the wrong time, if you have the long-term view of being able to hold, manage, and operate the real estate. So even if you overpay, in 10 years' time, you'll still feel pretty good. We're not a big fan of overpaying. In fact, we like to buy only when the blood is running in the water, to put it in Warren Buffett's terms. I read the obituary every morning. My wife reads the sports section. I look for people who are dead so I can buy their property from their estates instead of their having to pay estate tax. So, or helping them to pay their estate tax. So that might sound a little bit maudlin, but the only time anybody ever parts with great real estate is death, divorce, bankruptcy, or a partnership dispute. Because if you're lucky enough to own great real estate, you'll never sell it. Now, we as fiduciaries for our investors will sell real estate opportunistically sometimes if we deem that the return that we can get near term exceeds anything that we could get within the foreseeable, say, 10 years, and we're able to take that money and give it to our investors and they can reinvest it in something else. So we're opportunistic, and also we take advantage of all the tax benefits that we get in real estate, so we don't have to pay any tax or very little tax.
Well, you mentioned you just sold 2 properties. Were you in the market to sell them, or did someone just come along and make you an offer that you couldn't refuse?
Oh, they weren't for sale. We just got offered. We were constantly getting offers on properties because when you own properties on the west side of Los Angeles, you don't ever need to put a for sale sign on it or hire a broker. We get calls all the time. But we got some very attractive offers on these properties that were too good to turn down, particularly in a year where under this new administration there may be changes to the tax laws which would make it more beneficial to sell something this year than not if taxes are raised and there isn't enough tax shelter available from other real estate losses. So, it was a very smart thing to do to take the money off the table and distribute it to our investors. I think everybody was kind of happy because everybody always expects the worst when things are bad, and we always are contrarian and we say, oh, we're doing great. In fact, our best year was last year in the last 30 years. I don't know why, but it just was from a revenue perspective. So I think it just has a lot to do with, look at where we are. We are where everybody wanted to come to sunny Southern California during the pandemic because they certainly weren't flying to Europe or anywhere else.
That's a really good point. Let's take a break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram @Millionacres and on Twitter @Millionacres_co.
Did you know that only 1% of day traders actually turn a profit? So why are many of us mistaking picking stocks for serious investing? How do billionaires like Bill Gates and Jeff Bezos control their risk? They invest in blue chip art. Contemporary art prices outperform the S&P 500 by 174% since 1995. Masterworks.io is the only platform that lets you invest in paintings by artists like Picasso and Basquiat at a fraction of the entry cost. It's no wonder 84% of the ultra-wealthy collect art. Masterworks.io is making art investing accessible to everyone, not just billionaires and CEOs. Similar to real estate, art shares some of the lowest correlation to public equities, providing a way to protect your portfolio from market volatility. Masterworks.io recently sold their first painting, a Banksy work, for a 32% annualized return. With results like these, it's no wonder 86% of wealth managers recommend investing in art. Million Acres listeners can visit Masterworks.io today to skip the 20,000 person wait list. See important information at Masterworks.io/disclaimer.
I'm back with Larry Taylor of Christina Real Estate. We're talking about investing in Los Angeles. Right before the break, you started mentioning a little bit about taxes and potential tax changes. I've heard some things about 1031 exchanges potentially shifting. What else are you hearing, and why should people be aware of it?
Well, we're intensely connected to a lot of important people who are on top of these proposed changes, emanating from the White House and now being debated in various committees in Congress. We have this infrastructure plan that Biden is pushing hard, the Biden administration is pushing hard, and as a way to pay for it, basically to raise taxes on corporations, take away Section 1031, which allows people to trade properties without paying tax, increasing long-term capital gain tax to ordinary rates, which would take it from 20% to 39% potentially, plus the 3.8% Obamacare. The end of the stepped-up basis, which allows properties to be depreciated over a period of time, and then at the time of death, they get stepped up so that the beneficiaries don't have to pay tax if they sell the property. There's a lot going on, and a lot of it is going to change, but one thing is definite. There's this take from the rich and give to the poor, because the statistics are very clear that the wealthy grew extraordinarily wealthy during the pandemic. The middle class probably didn't do very well, and the poor never do well. And so this administration right now, which is catering more towards that situation where there's an inequity. And so Congress is seeking to fix that inequity in some way. But as you know, in this country, raising taxes is about as popular as the Tea Party. This country was founded on the basis of no taxation without representation. And now we have a potential increase in taxes with, modestly capable representation in a somewhat divided Congress. But I think realistically speaking, there will be changes. And I think that could cause more people to accelerate their decision to sell property now versus waiting until next year, where it could become less attractive because of taxation. So we want to be able to increase our capital now to take advantage of those who might feel like if they were ever going to sell, now's the time. However, because of the tax laws that have been in place since 1986, modified in 1993, modified again a couple times since then, but real estate is the only industry other than oil and gas that is treated specially by the government, because by stimulating real estate, the economy is stimulated. And this is just something that's been used forever. When Reagan became president in 1981 with the Economic Recovery Act, he just stimulated real estate. The 2017 Tax Cut and Jobs Act stimulated real estate. The reduction of the cost of money stimulates interest real estate. But the tax benefits, which many people cannot grasp, but you buy a property because you think it's going to go up in value. You're going to sell it 10 years later for more money, right? But from an accounting perspective, when you buy an improved property, the assumption is that the property will decrease in value every year for a period of years because buildings wear out. So depreciation losses are non-cash losses that are used to offset income. So on any income-producing property for the first 5 to 7 years, whatever earnings are made from rental income usually are offset by these non-cash losses. So that's basically how people in real estate become wealthier, because they buy more real estate to generate losses to offset the profits they're making on real estate they've had for a period of time that no longer has depreciation. So in our structure, we buy 5, 7, 10 properties in one entity, and we use the losses from the portfolio to offset the gains from sale. Like the properties that we just sold, our investors will pay no tax because they've got accumulated losses. But if you don't own multiple properties, and this is the way the government created this passive loss concept for real estate, which is if you only own one property and you generate all these passive losses, you can't use those losses to offset ordinary income from your wage or salary, your business income, even your dividends, which is considered investment income. So you can only use passive losses against passive income. And so millionaires in real estate became billionaires in real estate after these tax law changes. So in order to avoid paying tax, they just had to buy more real estate. So we buy 10 properties in one entity, and an investor gets the benefit that they ordinarily couldn't get by going out and buying a duplex, or I'm going to go buy a second home and I'm going to rent it out and I'm going to build a real estate portfolio. That doesn't work from a taxation point of view. And so far as the Section 1031, we've never done a Section 1031 to avoid paying tax, because really it makes no sense to buy a property, sell it at a property, and in order to avoid paying tax, go out and buy another property at market. So we buy a property, hold it, sell it, keep the profits for ourselves, pay no tax because we've got losses from the other properties. And that's just the way the real world works, and that's why Donald Trump will never show you his tax returns.
Well, I think that is an interesting point about the value of a portfolio. So within Christina Real Estate, you've got multiple portfolios, obviously on the west side of LA. Are they all the same types of properties? Obviously, you're balancing one against the other. Are you doing value add? What do those portfolios look like?
We're product agnostic. We'll buy anything on the west side that's prime and income producing, office, retail, apartments. Very little industrial exists on the west side, but from time to time it's available. More techie type industrial stuff. But we don't really care what it is as long as it produces rental income. And so our portfolios really, again, are mixed product. They're not product specific.
So your latest one is Christina IV. So what types of properties are in that portfolio?
In that portfolio so far, we acquired 4 multifamily properties from the estate of the original developer, with whom I had a relationship with going back at least 55 years. So when that patriarch of the family died at age 95 and had to sell some properties to pay estate tax, I was the first one they called because of the relationship. So we bought 4 buildings, very attractively below market, across the street from CBS Television City, which is about to undergo a $1.3 billion complete renovation by Hackman Capital, and directly across the street from Rick Caruso's The Grove Shopping Center, which is the highest grossing shopping center of its type in the United States. And these 4 residential properties, all multifamily buildings, are a block away. And they're also essentially a block from the West 3rd Street shopping district. And that's an area that we've been investing in for more than 45 years. So this is a market that we know very well. And on these 4 buildings, they're all on seismic upgrade list, which affords us the opportunity, if we so desire, to remove and replace them with new buildings that would be for sale condominiums rather than rentals, or simply just mine them for their opportunity. They were all bought under market. So we have a slogan around here is we don't believe in value add. That's for suckers. We only do value bought. If you can't buy something for less than it's worth at the time you bought it, you're just being a sucker hoping that it goes up in value, and we don't do that. And all this stuff about, oh yeah, we're going to put a new toilet in or stick some new landscaping in or put in a fancy entry system, that's just silliness. You make money in real estate when you buy it. And over time, of course, you'll add value if you know how you're operating it and you know what's important. But we always look for multiple exit strategies on any property that we buy. So we bought these apartment buildings. We bought them for 40% less than what they were worth. Sure, we'll fix them up. We'll do new landscaping. We'll raise the rents because they're all low. We'll turn over. We'll do some improvements. But we'll also, when we've already started, we've hired architects to design 4 new buildings. And we'll get the entitlements to do that, which is a long process to get the city of Los Angeles to give us the permits. We also purchased a development property just north of the Sunset Strip in West Hollywood. We bought a property there that has a couple of old buildings on it that are set to be demolished, but we bought it with the entitlement to build 22 new condominium residences. It sits above Sunset Boulevard with views of the city, and it will be directly across the street from a brand new 145-room Morphosis designed hotel, which is going through its entitlement process. So there's a little bit of a development aspect there. There's these 4 properties that are across from the Hackman, CBS Television City, Grove. And then we recently bought a corner property in the West 3rd Street Shopping District across from the Orlando Hotel, which we were part of the development team in 1982, so we've owned it since 1984. And we are selling that property to a very hip hotel company called Pally House, and they're going to rebrand it. They'll spend about $20 million on it. It's 100 rooms. We bought the property directly across the street. It's a corner property. We bought it for below market from an estate that was liquidating, with whom we had dealt with before we had purchased some of their other properties. And it's just like this fantastic corner with Magnolia Bakery on the northern corner, Pally House across the street soon. And that property, which is all retail, we'll probably clean it up and lease it short-term as retail, but it also has a new zoning from the city of Los Angeles that would allow a 4 or 5-story building, so we might develop residential over retail concept. But if we do nothing, it's worth millions of dollars more than we paid for it today. So again, we don't have to do anything except paint it and re-let it. So, and then what else do we have in the portfolio? Oh my God, I forgot about this one. We bought this magnificent building on the beach in Playa del Rey. I mentioned it earlier. It was built in 1968, 4 years before the California Coastal Commission came in, before the Coastal Act passed. So it was built just before development of its type was no longer allowed. It is directly sitting on the sand, adjacent to a public beach, which is extraordinary. That we bought from the 97-year-old developer who wanted to give the money to his kids before he died. And we were the first person that they contacted, and we purchased it. And we bought that property for about $10.5 million. It's probably worth $20 million as it is. So, but again, on that one, well, 2 things, we're cleaning it up, we're re-landscaping it, we're raising rents, and we're seeking to convert it to condominiums. And we think they could sell for about, it might be something around $2 million a unit at some point in time, which would be a $10.5 million purchase with a $4 million additional investment that would bring about $30 million. That's in that portfolio as well. I mean, that's a fantastic property.
That is quite a selection of properties. So how do investors get involved in that? This is a portfolio that's still open?
It's only open for about another month. It'll close July 1st. It's $50 million equity, about $40 million has been committed. About 75% of that has already been allocated to these properties that have closed. And there's just a short period of time, I guess, for people to invest. But again, prior to 2013, you don't know, but the passage of the Jobs Act, which allows us to be able to market the opportunity to 11 million accredited investors who would never have had the opportunity. We're very fortunate. We now have over 300 investors in our Christina, across the board of our 3 private equity companies, and we still have it. It's open. We haven't decided when we'll launch the 5th, but it would probably not be until the fall. And one of the reasons is there just isn't that much real estate to buy, so we have to feel very confident that if we're going to raise capital, we can deploy it. On the other hand, I'm feeling very comfortable that more opportunities are going to present themselves in the small to medium-sized office buildings where tenants who are in high-rise buildings are going to want to own smaller buildings of their own. So we're really focusing on that. So I think Christina IV will probably come alive later this year, early next year.
Interesting. Would you be seeing those as potential conversion properties or or do you think office is going to come back faster than a lot of people think?
Well, office is already coming back as soon as, there's clarity about, what the liability is to companies for requiring employees to come back. But there's a heightened sensitivity to high-rise buildings that have closed ventilation loops and that have shared common bathrooms with multi-tenants. So for tenants that occupy 1 or 2 floors of an office building, say 20,000 feet, if you could give them a 20,000 square foot office building that they can utilize for their own business where they don't have to share it with other tenants, that's something that's on the move right now. So we have 2 of those right now in our Christina IV portfolio that are just doing fantastic. And there's a lot of demand that we're seeing for it. So we're starting to focus on that a little bit. But generally speaking, as I said, if it's on the west side and it's a good deal, we'll take it. And debt is still available and very cheap, so it affords us the opportunity to have leverage, which increases the rate of return to our investors. And we're not one of those real estate investors that are looking to generate monthly cash flow. We're all about buying great properties, owning it, managing it, operating it, and extracting money out, either from selling an interest to an interested party but keeping the majority of it, or taking advantage of financing from the 10 or 12 banks that we have long-term relationships with. So if we can return our investors' capital, either through operations or through financing that's priced well and is conservative, the idea is to get the investors' their money back completely. As in our Christina I portfolio, we've now returned about 93% of the original capital. We've sold 4 of the 7 properties. None of the investors have paid any tax because the shelter from their investments has covered the profits. And we own the other 3 properties essentially without any capital. So, you got 3 buildings essentially for free and got all your money back. And that's the way you make money in real estate.
When was that Christina I fund created?
It was 2014.
Oh, nice. So interest rates, you just mentioned favorable lending. Do you think it's going to last? When is this going to end? There's been a lot of talk about this over the last couple of years. Definitely didn't happen yet. Is it going to happen soon? Is there a window of opportunity here?
I have been wrong on interest rates for most of the past 10 years. But when I started in the business, an average interest rate on a 30-year fixed rate loan was about 7%. And during the lifetime of this firm, we've paid as much as 25% per year for interest. We lived through a prime rate that was 21.5%. So there was a time period after Reagan became president and the rates went down from 21.5 to 12 after the Paul Volcker experiment during the Carter administration, which actually did a great job of breaking the back of inflation. It just put us into a depression. But that was 79 to 81. Right now, we've never in our lifetime seen interest rates at or near zero, and a lot of our investors from overseas that are in Europe, they're at negative rates, or they're just starting to reach positive. Negative rates. I mean, imagine. For my real estate in Europe, I pay almost nothing for interest. So when will it end? It's very hard to say. The Fed today and yesterday, in their open market committee meeting minutes that were released, started discussing tapering because they're buying $80 billion a month of corporate loans and all their kinds of instruments. So when that buying starts to taper off, that's another way of putting pressure on the cost of money. But the last time they tried to raise rates, it didn't work because we were raising rates in this country and Europe and Asia were lowering rates. So we just actually live in a very low rate environment, and we have for the past 10 years. But rates will move. And one thing that's happening that most people probably aren't aware about, but we are because we're also investors in banks. It's one of the, I mean, not for our investors, but I mean our firm has investments in banks. So we invest in banks so that we can get an inside look at what the cost of money and availability of money is coming down the road. So when you're an investor in a bank and you have access to top management that's communicating with the Fed, you're learning ahead of what the public is. And right now there's a squeeze in margins. So the spread between what banks are paying for money and what they're putting money out is starting to squeeze. Margins are reducing, which means it's becoming less and less profitable for banks to make loans. So at first, they make even more loans to be able to generate the same amount of profit as they would have made by making less loans. So how do they make more loans? They relax their underwriting criteria. Once they relax their underwriting criteria, more risk happens because those are more borrowers that are likely to go under. So that's kind of what's happening right now. The margins are squeezed. The banks are pushing money out as low as 2.5% on a 10-year fixed rate interest only. But the funny thing about real estate is that one of the tools of valuation is the rate of capitalization, cap rates, which is usually thrown around. And cap rates follow interest rates. And so if interest rates are low, cap rates are low. There's a relationship clearly because a capitalization rate really means you take a stream of income over a certain period of time and apply a rate of interest to it to determine what your return is. So, but what happens is, since if you can only earn 1.55% interest on a 10-year treasury today, the one thing you know for sure is you're going to get your money back at the end of 10 years and you're going to get your 1.55. Anything beyond that, you're taking a level of risk. But let's say mortgage rates are 2.5 and cap rates are 3, right? So if you bought a building 10 years ago and the net operating income was $1 million, but you bought it at a 5 cap, and today the cap rate's 3, it automatically suggests that the building went up substantially in value, but it doesn't. It's the same building. In fact, it got older. There might be competition in the marketplace. The net operating income might have gone down, but because the cap rate went down, the value went up. So you have a tremendous amount of unsophistication in the marketplace because a lot of what I call very, very smart MBAs will sit and try to figure out valuation based upon these formulas that they learn in business school, which have some value, but standing alone, they don't have any value. They have to be taken into context because there's no two properties that are identical. And so these are the kinds of things that, are very hard to communicate to investors who are unfamiliar with real estate. And they're very hard to communicate generally. But there's a lot of things that give value to real estate, but the 3 most important things have never changed in my lifetime. And that's location, location, location. Those are the 3 most important things. Everything else below that is, you get location, 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 price. It's like the Japanese, when they were investing big in the 90s, they only bought AAA location, prime trophy assets. But they overpaid and they lost their ass. Okay, so even if you get the location right, they bought Rockefeller Center and lost that into bankruptcy. How could you buy Rockefeller Center and own it and lose it? But they did. So location, 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 price, and then you better have some brains running it. Okay, and that's us. All right. You've got to have a sponsor that knows what's happening, and it's impossible for somebody in China to understand the property market on the west side of Los Angeles. They just can't. They just can't. We know whether or not the property is better on the north side of the street versus the south side of the street. We know what's happening. We know who's developing what and where. We know the politics. We know the government officials. We're on a first name basis with the right people who are in control of what's happening. Outside parties can't have that, so you have to have the sponsor. That's what we bring to the table, and that's why people invest with us, because we know what we know, and we're very quick to tell you what we don't know. We don't know anything outside of our region, and we don't want to know anything outside of our region.
I love that. That kind of brings me to another question, though. Foreign investing, you mentioned Japanese in the 90s. Last few years, China has, been buying a lot of things and then stopped 2019. It, stopped a lot of investing. Some things did go into bankruptcy. Are you seeing foreign investing come back to the West Side, or not quite yet?
Well, foreign investing has never left the West Side. We've always drawn foreign capital. What's happened is the entry barrier here is much greater than it was years ago. So, 35 years ago or 40 years ago, if you showed up with a suitcase of money and bought a building, you were in. Today, for a lot of reasons, we're very skeptical. We have AML, anti-money laundering. We have, reporting requirements under FIRPTA. Any transaction in the West Side, in this region, that closes for cash in excess of $2 million has to get reported to FinCEN, which is the Financial Crimes Investigation Unit of the Treasury and the IRS. So, but we have long established foreign investors that have been here for a long time very successfully. But the flow of capital coming in from foreign investors is constant. It doesn't matter whether it's China or Japan or Saudi Arabia or Singapore. There's a constant flow, but they are flowing into more established entities that they've set up years ago. But there's always a political twist to it. Like, nothing was wrong with the investments that China made. It's just the President Xi decided that too much money was leaving China and going to the U.S., and he was calling it back. So, but as far as the demand from Germany, England, Ireland, France, a lot of these countries, Ireland particularly, Finland. I mean, we have investors from all over the world, so to speak. But that capital coming in has issues with respect to whether or not it's appropriately being brought here from a regulatory, relationship. But it's doable.
Well, this was fantastic. Thank you so much for your time today. I think gave us so much wisdom here. So, reminder to listeners, you can learn more at ChristinaLA.com. You can always email us at media@millionacres.com to share your thoughts. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss that Million Acres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.